In a tough economic environment, mining companies are looking to invest in and develop projects that bring greater shareholder value. So for more on issues mining companies are facing right now and those wishing to develop new mines or expand existing ones, we're joined by Klaus Finter, Chief Operating Officer at KPMG Global Infrastructure for Africa. Thanks for joining us today, Klaus.
Thank you very much.
So that, of course, has been something that's been reiterated by global mining company CEOs from BHP Billiton to Anglo Gold Ashanti, Mark Funny now at the head of it, is what they're going to do to make shareholders really reap the rewards of where they're putting money right now. So how has this shaped the way that they approach projects?
Yeah, I think the infrastructure related to mining, it's very important to unlock this value. And when you go, and I would like to unpack it first, the resource-driven growth in Africa is very important. Even in mature market like South Africa, where it's declining, but still has got 500,000 employees in South Africa, and roundabout it contributes to 50–60% of the forex exchange, the resource export. So we must ensure that we have got infrastructure in place who can underpin this growth going forward. Now, in South Africa, I think it's the most developed market and with the best infrastructure. We have got significantly 3 different corridors. It's a coal corridor, Waterberg to Richards Bay. We have got the manganese corridor down to Kucha, and we have got the iron ore corridor to Saldanha. All of them are operational, and compared to other corridors in Africa, very, very well operational, but still it's not enough capacity to underpin the growth.
You mentioned infrastructure there, but naturally there should be some major challenges that come out with the building infrastructure with regard to that, and I'm sure cost is a major factor there too. Yes,
definitely. And especially when you look, the mining houses are investing in big mining projects on its own. But these investments are idle investments, idle assets, if they're not underpinned by an associated infrastructure. Only take the example of Rio Tinto in the TED region. The TED region in Mozambique is one of the biggest coal areas. We have got Rio Tinto, Vale, Jindal, ENRC investing in this one. Rio Tinto took a write-off this year at the beginning of the year of around about $3 billion on their assets in Mozambique. And this was partly due to the resources, but also mainly to the lack of infrastructure on how to export them. So it's a huge imbalance in this one, and the problem is you need an integrated approach. On the African continent, I think only Transnet has got the mandate to deliver infrastructure ahead of demand. Now, are they keeping ahead at this point of time? No, not necessarily, because the balance sheet is stretched with all other kind of investment in this country, like also the pipeline going up from Durban. But at least we have got something here in place which allows the mining house to get confidence, but it's still not enough.
I mean, one of the issues that potentially we could look at going forward is, in the example of, for example, Vale, TED, is you've got that as a sunk cost essentially right now. So they've got to look forward and look at investments in Africa, given the fact that we do know there's an infrastructure deficit. Is that going to mean that mining houses are going to reassess investments in mining going forward right now? Is that going to be something, given their experiences already, you're going to see a slowdown in investment?
Yeah, first of all, the investment in the TED region is not a sunk cost. It's still a very huge investment or coal resource which can be exported. And you look at Vale currently is developing the Nacala corridor, which means round about 950 kilometers of rail infrastructure and associated port infrastructure, comes up to a capex number of around about $5 billion. And they are paying this out of their own financial capacity to allow round about 20 million of tons annual export of coal. So there's still a big game. Now, the point was, you're saying, is it a threat for international investors?
Yeah.
Yes, it is, because investors don't like risks. And if you have got risk attached, like maybe the development of infrastructure is delayed, it has got enormous impact on the overall cost of your mining assets.
In terms of your advisory, though, has it slowed down investment already in Africa? Do you see it as a factor that is already impacting the numbers and the amount of investment that is flowing in?
I think it depends again on region and which kind of sector. You can see a slowdown in these kind of investments, or a little bit of being cautious around it, but still, the underpinning business case, the viability of this mining asset is also very important. Even if you have got copper mining in Zambia, which at this point of time takes you to export copper by truck around about 20–22 days. But the volumes are not as big. The copper itself is quite high valuable commodity, and therefore it's still a viable business case even without a functional infrastructure behind it.
What would you say the comparison is between countries like, or continents like Africa and the likes of Australia? Is infrastructure more robust, or are they tackling it in a more robust manner in the likes of Australia than they are in Africa?
Yeah, I think the big difference is now you compare a continent out of 53 countries with one single continent, Australia. So the decision making is much easier. So you've got cross-countries issues in Africa on top, a regulatory environment which is not as developed as in Australia. That's number one. Secondly, in Australia, you've got often single commodity lines. So you develop one line who's only doing coal infrastructure or exporting coal. In Africa, it's normally multi-purpose use. It makes it much more challenging also to find financing for these kind of projects, and then on the long term also. So it's easier for Australia to be more efficient, but it's also, of course, we can also improve in Africa.
Mm-hmm. An interesting point that was made in your assessment of mining projects and the whole issue around seeking shareholder value is this engineer, procure and contract model, EPC model. Tell us about that right now and how that's shifting the way mining companies are looking at project deployment.
So now it becomes technical at such a late hour. EPC contract is you outsource one contract, and the contractor will have got the whole responsibility to deliver this either mining asset or this infrastructure asset behind. So you give up a little bit of influence on how to shape this infrastructure or adjust it, but of course you have got much more certainty that you get for one specific price a whole infrastructure. So you outsource the risk to an external party. It comes with higher cost attached to it, number one, but for funding of infrastructure projects is a preferred or mining project is a preferred model, because then the funding institutions have got certainty and they rely that this EPC contractor can manage the risk, and if not, that his balance sheet is good enough to overcome cost overruns in this one. So it's a preferred model going forward. You've got EPCM contract, like a management contract, contracts like currently used by Eskom in South Africa for the big power plants. They've got,
but that didn't work out so well.
But because you keep also some risk to the developer in this case, and not outsource this risk totally to the EPC contractor, to the construction companies, and then you rely still on the management risk of these different resources coming together, and that's where the problem lies here.
Mm-hmm. Klaus, you mentioned a lot of outsourcing there with regard to that EPC contract. With a continent like Africa, where very few people are skilled, never mind in understanding or knowing how to expand a mine and build new mines and increase infrastructure there, is there enough skills transference between locals as well as internationals when it comes to that kind of EPC contract?
I think it also depends again from region by region. So you have got also your localization requirements in all countries, like South Africa is very strong, but all other African countries becomes more and more important that you also use local labor. And when we're talking about these kind of outsourcing, I mean mining activities and infrastructure activities, civil works and stuff, it's quite low skilled for majority low-skilled worker class requirement, and therefore the transfer of knowledge in this regard should be definitely done and is also undertaken. I think it's become more